This is Asia Times Deputy Editor David Goldman speaking to you from New York, the evening of April 8th. Well, the United States is running a trade deficit larger than it ever has in the past, about double what it was a year ago, nearly $1 trillion a year, as the flood of demand into American households turns into imports of goods that the United States can't or doesn't want to make, particularly consumer electronics, medical protective gear, medical equipment, and so forth, and China has been the biggest beneficiary. Where does the United States get the $1 trillion a year to pay for all these imported goods? Well, the answer, as suggested by a number of Wall Street strategists, is by selling equities to foreigners. America's had a booming stock market, and foreign demand for American stocks is considerable. And if you look at the chart, you'll see a thick blue line, which is sales of stocks to foreigners. That's about $400 billion in the past year. And contrasted to the skinny dashed line, that's foreign net purchases of treasuries, which is down by about $600 billion over the past year, according to the Treasury International Capital System. The U.S. is also selling some mortgage-backed securities to foreigners, but corporate bonds have also been in decline. So effectively, we're financing the world's biggest import bubble off the world's biggest stock bubble. It's one bubble supporting another bubble. Now, back when I was at Credit Suisse in the early 2000s, we called this a death spiral convertible bond. And we did this for Enron, the energy company that spectacularly went bankrupt in 2001. The idea was Enron would issue debt. And if it couldn't pay the debt, why, it would just issue more shares to raise the money to pay interest and principal. Now, of course, since nobody wants the shares of a company that can't pay its debts, the stock would go into a death spiral when this was attempted. And here's the big risk. The Federal Reserve has kept interest rates at negative levels for Treasury securities, at least up to the 10-year maturity and a bit past, in real terms. It's bought $4 trillion worth of Treasury bonds in the past year. It's kept the overnight rate at around zero. And this has supported the stock market bubble. There's a nearly one-to-one relationship between falling real Treasury yields and stock prices. Investors have nowhere to go with negative real yields on treasuries and high-quality corporate bonds, so they buy stocks. And of course, foreigners don't want to buy American bonds at negative real yields, so they buy stocks instead. So the Federal Reserve's largesse, this enormous fiscal and monetary stimulus, supports an equity bubble, and that supports the economic bubble fed by imports. Now, of course, what happens if the Treasury runs into trouble financing this gigantic deficit, 20% of gross domestic product? Why, interest rates have to go up to get people to buy treasuries. And if interest rates go up, stock prices go down, foreigners sell, and we get into the kind of death spiral that we saw for Enron. How likely is this to happen? How soon is it likely to occur? Well, I don't think it'll occur this year, but it certainly could next year. How likely is it? It's hard to say, but it's a significant risk. That's why I would be cautious about the stock market bubble. I'd own some gold, and I would be afraid, in fact, very afraid. This is David Goldman speaking to you from New York on April 8th.